Welcome back to the Stock Market Options Trading Podcast. My name is Eric, and this episode is the second half of my discussion with Losada around trading SPX options. And we're about to get into the way he approaches trading SPX credit spreads the same day of expiration. And if you didn't catch the first half, part 1, be sure to go back and listen to episode 5 when you get a chance. You're not going to want to miss that episode either. Now, don't forget, real quick, we are not financial advisors, and everything in this episode and on this podcast is for informational purposes only. So enough with the intro. Let's get into the episode. Let's get into the trade, right? So you said something that made me think about the mindset, right? So when I'm trading longer dated options, and we're specifically talking about, let's be real clear here. We're talking about trading SPX credit spreads. And when I go to put on a 60-day spread, I had a system. I haven't been trading it the last couple months because of the crash, and it's basically a stock. I call it the stock market insurance. It's the insurance trade. You're
Correct.
It's a put credit spread,
right?
And you're saying the market's going to stay above here. I actually try to sell it when the market goes down, but that trade is more around time and not really even volatility, other than the fact that I want to sell it on a down day if possible. I'm not looking for a certain IV in the market. I think that's all.
It's relative.
It's probably good for stocks. It doesn't matter because at some point the IV is going to be so low that you either just won't trade. You got to trade something, right? So, so my criteria, if you will, for that particular trade is I was trying to put on I was putting on a new 60-day spread every week, and I was overlapping my trade. So my entry is days to expiration. I want to put on a trade with, usually 60-65 days to expiration. I want to get 50%. At that time, I was trying to get 75% of the profit. Tends to be 30 days in the trade, give or take. But then as you get closer to zero, right? So when we're doing this scale of days to expiration, you start getting more technical. That's what I found, and that's how I do. It's like, okay, you mentioned, okay, I'm hitting support and resistance, right? I would never even think about that on my 60-day spread.
Correct.
I don't think about support. I don't think about resistance.
Yeah.
Now, recently, I've measured the recent low of, and I forget what it is, 2200, or maybe that's wrong.
Yeah, 2190 around.
Doesn't matter.
It was around 2190, I believe.
Yeah. So 2190, right? I got it up now. To me, that's significant in this moment. So I was actually pricing out 60-day spreads last week, and for the credit and distance that I like, I usually look at delta. I'm selling delta 15-ish, and the premium's actually pretty good, and I'm getting hundreds. I'm like, I can get 500. This is great. 500 points away. This is 60 days. That's insane now compared to like last year. And I don't want to get, we all know the volatility is higher, but even 500 points away from the market closed Friday, 28.30, that puts me at 2,300, which is still above the recent low. That's about the extent of my technical analysis. It's like, you know what, if we retest the lows, great, but I would prefer to have my spread near the low. It's pretty close. If we sell off hardcore next week, I could probably get below the low, and I'd look to sell something 60 days out because the volatility is going to be high.
Yeah.
But then we fast forward into like 7-day stuff. I was doing 7-day stuff for a while, and I plan to go back to that, and it was still technical based. So what technical things are you looking at for that? Are you looking? So I'm assuming you look at the day before, and you're like, okay, here's my levels. Here's what I'm seeing. The market's been up 3 days in a row. How do you get that? Because are you looking at like delta of a trade? Like, are you saying, okay, I like to sell delta 20 spread, or does that even matter? Or you're just trying to find the level you like and sell around that level?
Yeah.
So, how are you doing that?
So a lot of things. One, it depends on the trade. For 0-day, I don't even look at delta, to be honest with you. I'd look at the premium. And I know the delta factors into that, but the premium tells me where I need to be, right? And the premium doesn't change whether I'm 100 points away or 10 points away, right? So obviously volatility, right? The lower the volatility, the closer you are going to be to the money. But I always look for a premium of 35 to 70, and I hardly ever get 70 now. It's really around 45 or 50 premium that I get. And I've looked at the delta, and it's around 12.
Well, let me pause you.
Yeah.
Can I pause you there real quick?
Absolutely.
When you say you want to get 50 to 70, you're saying 50 to 75 cents per spread?
Correct. Exactly.
Okay, and what's the width you're doing of the spread?
I do 5 wide, 10 wide. 5
wide. Okay, so and I just want to kind of I want to make sure the listeners understand what you're looking for. So if it's a 5-point wide spread on SPX, that means that's going to take up 500 in capital.
Correct.
For your trade, and you would look to get 50 cents.
Yeah.
Ish. 50, 60 cents. Okay, so just from a capital efficiency standpoint, and I talked about this on my last episode about capital efficiency of spreads, and I wanted to just kind of factor that in here. So if that trade works out for you, that's about a 10% return on capital for that day. Does that sound right?
Yeah, if it expires, if it expires worthless, that's correct.
If it expires worthless, right? Now, obviously, the risk is you're risking 450 in the 50-cent example, and maybe it's max loss, which I know you don't let happen, is going to be 450, and the max gain is going to be 50 cents. But since it's higher probability, you're going to have more winners and losers. But so is that what you're looking for? Is how much when you say premium, how much can I sell this for? And if you can't get 50 cents or 60 cents, you're like, okay, maybe I won't do it. Is that how you're looking at it?
Right. Yeah, correct. And there's different ways to trade, right? I mean, if I look at a certain volatility, and when volatility was around 70, right, around 60, 70, right, we were looking at I was looking at a 50-cent return, a 50-cent premium, but I was 100 points away from the market, right? Now that we're around 30, in the 30 range, right?
Right.
Basically I'm about 50 points away from the market now, with the volatility where it's at.
Gotcha.
So,
right. Interesting.
Yeah. So it is a delta, equation ultimately, because the delta is going to dictate what that premium is, based on the distance to the market. And so with 0-day, I just look at the premium, and that'll tell me whether the trade is right or wrong, and then going into that trade too, I look at where those support and resistance areas are, and is it far away, from my position, or is it close? And that's a factor too of sometimes whether I decide to trade or not, as well. If we have a high volatility, and sometimes it's skewed, right? Volatility is skewed. And so if we have a day that the volatility is higher, but yet the premium is close to the money, something's wrong there, right? There's something off, and I just won't trade. I won't trade on that day.
Right.
But again, going into, and then there's strong support and resistance, and there's weak support and resistance, right? And so I use different methods to identify that. And even during the day, I use what's called IBL, initial balance level, which is the high and low of the market within the first hour, right? And that automatically, because traders use it, right? They use it, especially futures traders.
Yeah. I was going to ask about that. Yep.
Yeah, that creates a support and resistance level that I use as well. And I'll be trading, and it say, okay, if If it breaks this level, and I use the 5 minute, right, to confirm it, because a lot of times we could dip, below that support or resistance level and then come back up. I'll wait till the 5 candle closes, and if it breaks that support, I'm out of the trade. So it's not a lot of people use a 1x or 2x or 3x, right, to determine when they're going to take their loss, right? I don't use that. I use those levels. And I did it Friday. Friday I took a loss, and but it was, I got a 45-cent premium, and I closed the trade for 95 cents. So I took a hit on it,
Right.
almost
Okay.
one time, but it continued going down after that, and in the end, if I would have held on,
That's standard, right? I
right,
mean, that's
exactly. I
yeah.
would have held on, it would have been fine. But it's that one time that thing goes right through the money that you'll get a max loss,
Yeah.
and it'll take away 2 months of earnings, of gains.
Yeah.
And so I didn't even blink on that one.
Yep.
I took the loss,
Yep.
I walked away, and that was it. And that's part of the discipline of trading zero DTE, because it's very easy to get stuck and take one big loss that'll erase your gains for a couple months. Yeah. So so that's what I do with zero DTE.
Yeah. Let me go back to something you said real quick.
Go ahead.
Let me, because I want to make sure I understand. So because I've read some stuff about the opening range breakout. So, and there's different kind of theories about this, and this is something I'm actually going to get with my. So I have a guy that helps me do back test. Back testing is not the right word, but he's better at it with the data than I am. But one of the things I wanted to explore here, and maybe I can try to get some numbers here for you. So you wait for the first hour of trade to chop out a range, and then you use a 5-minute bar, like so. And if I misunderstood this, please correct me. Then if you close above that range, then you're going bullish for the day. Is that how you do that, or maybe I made that up?
No.
How do you?
No. I use the.
How do you define the opening
areas.
range, or are you just using a 5-minute bar the whole time?
Okay, so kind of take a step back here. So normally I get into the trade in the first 5 minutes of the day.
Okay.
And the reason that I get into that, I get into the 0 day at that time, is because the implied volatility is the highest of the day, typically at that time. And volatility is the biggest factor for 0 day, bigger than theta, bigger than direction. You can be directionally wrong on a trade, but if you enter a trade when IV is the highest and get out when it's the lowest, that's really ideal, right? And even if the trade goes against you, you'll notice that the premium, the premium decay is the quickest during the first half hour of trading, and so I don't use those ranges to determine when I'm going to get in. I use those ranges to determine possibly where I would get out. Okay, if I have to close the trade, for a loss.
I see. Okay,
but those first hour ranges could be irrelevant if I have a very strong support and resistance, via fibs, right? In those areas where I already had planned to exit the trade. I'll let it go through that range. If I have a much stronger support area, past that range, that I'm watching more. So, also, yeah, if the premium, if it goes against me quickly, I'll probably get out of the trade, as well. Just, you don't want to be aggressively wrong on the direction either, on a 0 day, because that obviously the direction will work against you as well.
Interesting. Yeah, I'm going to start kind of paying attention to that. I guess my initial thought of that is, dealing with gaps and picking which side you're going to trade. Now, like, and I'll just bring up, Friday we had a big gap down. Amazon, Apple reported earnings after the bell. I was long the Nasdaq, so I took a hit on Friday. But when you have that opening gap down, does that? And I know you have levels and things. Are you, I think you said you took a loss Friday too. So I'm assuming you traded the put side on that.
I did. Yeah.
Do you ever do both? Like on a gap down, would you do a condor?
I
Just
do.
from a volatility perspective?
Yeah, I do,
Or
and I
okay.
probably should do them more often. But my analysis initially is trying to get the direction right too. And so
Yeah.
I always tell new traders, hey, just trade with the trend. That's probably the safest,
Mm-hmm.
the safest way. Look at futures overnight, what trend was going, But what I do is I look at
Well,
the trend.
the trend was up until Friday, right?
Yeah,
So
exactly. Yeah.
yeah,
But Friday was a continuation of Thursday, right? I think Thursday went down as well. I believe. I think Thursday went
I
down.
mean, you had a pullback, but you've been in uptrend, so you were up. Well, it wasn't 4 days in a row, but you had one down day. I mean, it was,
Yeah, it was
you
down
hit a new
Thursday.
high. You
Thursday.
hit a higher high.
Yeah,
You pulled back.
we
Yeah,
hit
you
the
pulled back a day on Thursday.
yeah. But anyway,
Hmm.
but when the market goes
Yeah,
to an extreme overnight too, a lot of times it'll reverse, right? And so I look for that as well.
true.
And
Yeah,
and I thought on Friday we were gonna reverse, and that's why I took that trade. But I was wrong. I was wrong on it, and I just
yeah.
took the loss. And so
I was hoping we reversed.
you too.
I was I was hoping we were reversed.
Yeah,
I was long. I wasn't I didn't have an option trade on, but I was long
yeah, yeah. No, and I've
I've
got
been trading leveraged ETFs. I was
yeah,
long TQQQ, which is like
hmm
um a triple. So
yeah,
took a little hit on that one on Friday,
yeah.
but
Yeah. No, I
interesting.
thought we'd reverse, but we actually may continue going down on Monday. We'll see. But uh, what plays into that too is we got all this stimulus, and I mean that's really clouding the
Hmm.
waters. Or else, as a trader, we're going to test the bottom, right? But with all the stimulus and how far the market's gone up,
Yeah.
and it just clouds the
It
picture.
doesn't make yeah, it doesn't make sense.
Yeah.
So um so I you know when I was growing up, I hated economics. And now I wish I had really paid more attention. So I've been trying to just better understand, because the traditional sense of economics of what they've done since the last 30 years, I'm trying to get more educated, if you will, on this, because what they're doing is unprecedented.
Hmm.
And we hear about these long-term side effects. We're not really seeing it,
Hmm.
right? We haven't really seen it yet, I don't think. And you got the gold bugs in one ear, and you got the Bitcoin people in the other ear, that all fiat money is going to go to shit, and which is probably true. But here, interesting, and I know we're getting on sidetrack about Fed policy
Hmm.
and currency, but gold has gone up, uh, but there's a lot of strength in the U.S. dollar despite the money printing. If you look at,
Hmm.
I just look. I don't trade the dollar, but if you look at UUP,
Hmm.
that's kind of the ETF that I just sort of watch. It is not going lower, and
No,
it it's and there's something about the I think it's called the cleanest shirt in the hamper
that's
or something
correct.
like that.
That's correct.
There's still this flock to the US dollar, which is muting the gold move,
Correct.
which I think the side effect of that is like, well, I guess it's not so bad if gold isn't going up or whatever. And I don't know enough about this stuff. So I'm trying to educate myself more on the economics, because I think one of the hardest things for retail guys like us, and especially if you're new, is just making sense of it all. And this is where you have to try to remove reality. And this point, it's clearly a discrepancy what you see in the market and what you see in the, you have announcement, oh, 5 million people lost their jobs last week, and the market's up 2%, and it just doesn't make any sense. And I've been overly bearish in the past, and I've always lost. I actually lost on a bear call spread just like a week ago, because it feels good, right? It feels good to say, okay, I have some bearish stuff on, but then you get like the biggest rally since 1987 or whatever, biggest 1 month rally up 12% or something. It's the biggest 1 month rally, and then you're ultimately wrong in your trade, and it doesn't make any sense. And so that's one of the things I'm trying to improve on is just from understanding economics, but getting better at, and I know with 0 day, none of that stuff matters, right? It just matters what's happening that day.
Yeah.
But just getting better at getting more technical and
Yeah.
more mechanical, I think is
Yeah.
the way you're going to be more successful.
Yeah. And I mean,
instead of trying to be right.
yeah, pure technical traders will tell you that, the market peak to trough, right? It's basically 100%. So you draw the fibs on those dailies, right? And the market went up, 61.8%. It from the 2190 low, it got up to the 2900 level, which is the 618 on the fib. And a pure technical trader will say,
right,
this is the 618 is a typical bouncing point for the market to go down, And if you think about it, we had great news, right? The earnings and for Amazon and Apple that day weren't great, but are those really going to move the market like that? I don't think so. I think it was just time for the market to come down.
Yeah.
And it has to consolidate.
Yeah, we'll see if we'll get any follow through next week.
And as far as the dollar, I do watch the dollar. And the reason I watch the dollar is because close to 50% of revenues for the S&P 500 come from overseas, right? And so when the dollar gets strong, that prices our goods and services higher, and so there's going to be less demand, for those services, and so it does affect the SPX, but in a world where other countries are at negative rates, and we're still positive, and we're not going to go negative. That's one thing I really am pretty confident of, that the Fed is not going to allow rates to go negative, just because that's the banking destruction of, forever, I mean, you just can't, I can't see how banks can function with negative rates. But so the market looks at that, and you're right, we're the cleanest shirt in the laundry here, because there's a confidence here that we're not going to have negative rates, so the dollar is going to stay relatively stronger, in a world where we have all this decoupling in interest rates. And so so that's kind of how it works. And the other part of this is the stock market is a discounting mechanism. It doesn't look at what's going to happen within the next few weeks. It looks at what's going to happen in the next quarter or couple of quarters forward, and everybody knows that this thing is gonna go away eventually, and so it's looking at the future here, for where the market is going to be, and it's pricing that in. It's just pricing that in, and that's the only way that you can explain how this market has gone up when we have over 20 million people unemployed, at this point, and so
I think it's 30 now, right?
Yeah, it's probably close to
30.
30. Yeah, 30.
Yeah.
20, 30,
Good point. Yeah, and I just brought up SPY, and I just put the fibs. Yeah, you're right. The 618 was at 292, and we basically closed above it, and it pulled right back. The interesting part too is I used to do a lot of fibs in the past. I use a lot more moving averages now. But the 200-day moving average is actually not much farther up.
It's right around the 3,000.
I personally think
we're close.
It's around 3,000, right?
Yeah.
I think we would hit that. I think that would make sense to hit that. I think that would be resistance. So I'm still hesitant to sell call spreads out 30 days because,
Me too.
from a, and I know we're we're getting totally out. This is going to be the longest podcast in the history of podcasts, but I don't care. But I was volatility spiked. We're getting that pullback, and I wanted to pull a trigger on like a 30-day bear call spread, which would have put me at. I could have got something decent above the around 3,000, right there. But I was like, well, I think we can get up there. So we'll see what happens. And I think with all the reopenings that are starting to happen, I know we're both in Florida here. I know you're gonna at some point go back to Puerto Rico. You're back and forth. But they're starting to open some of the parks. And so there is some opening. I don't know what that's going to do. And then you hear reports of Japan. I think that's what's the next one that they're seeing a resurgence of cases. And I don't know if they're going to lock it back down, but hope is on the horizon. How long that will last in the market, like you said, it's looking forward. Who knows? I think that the damage has been done, but we know, you and I know, that the market isn't. It's not the economy. It is forward looking, like you said, and it's just. I think if we all just admit that nobody knows, and you just as best try to trade it in front of you, and if you're not comfortable, don't take the trade. And so one more thing, because I know we're hitting an hour here. I think both of us have the same thing. We probably haven't said it, but for you to say that you have capital, right? And for you to go into an opening day and say, okay, I got X amount of capital, I'm looking to do 0 DTE, and it doesn't, for whatever reason, you're like, I'm not going to trade that today. That is the biggest, for retail traders, the ability to not trade is such a huge thing. And I think the only way you learn that is by losing. And so I'm glad to hear that. And I know that you're not like that, but I really like to point that out, because when I talk to newer traders and they're like, well, what are we doing today? Or why didn't we take a trade today? And they look at the hindsight, right? They look and say, that trade would have worked out. Why didn't you do it? And I think, and that's what comes with experience, not being greedy, and ultimately just being okay with your money just sitting there and not being in the market all the time. And you're probably in the market with certain, you got chunks of money doing different things. But I just wanted to point out that that is a great way to just protect your capital, and just to understand that cash is a position. If it doesn't meet your criteria, whatever your criteria is, and being okay with it's you feel like a genius, right? It's a genius idiot syndrome, where you're like okay, and this is the hard part of not being in the market. Trading and just having cash is hard, because you're like, okay, I'm gonna take this trade. You're like, I don't know, it doesn't feel right. What about this? What about that? You're like, okay, I'm gonna stay out of the market. Well, if it does what you thought it was going to do, and you would have made money, you're like, I'm an idiot. I should have done this. I should have stuck with this. I need a better plan, whatever. But then when you were right, you're like, oh man, I'm so smart. I knew that wasn't a good trade, and I was right. And that hindsight of getting over being right and wrong, and just saying it's not looking right. I don't know. I don't want to manage that. I got a doctor's appointment today. I don't want to be in a trade and have to try to. Do you ever? You're in that situation where you like? Let me ask you, do you do doctor's appointments on Monday, Wednesday, Friday? Or you're like, no, I need to do that on Tuesday, because I don't like trading short-term stuff when I gotta pick up my kid. I got basketball on Monday, and my daughter does piano, and I'm like, okay, I can't. I don't want to. How do you deal with that, that stuff for the day trade?
I mean, I travel on Tuesdays and Thursdays, purposely, when I travel, and
I knew it.
On Tuesdays and Thursdays, that's it. On Monday, Wednesday, and Friday, I leave it clear, for those days. Yeah, absolutely.
Yeah.
Because it does take up, sometimes it'll take up a couple hours, sometimes it'll take up more, and so I don't want to be distracted. during those times. So yeah, absolutely.
Yeah, and it's and it's unfair to the people around you,
Right.
when you're constantly looking at your phone. I mean, even I'm checking futures at night.
Yeah.
I get crazy. This the only time I'm not checking stuff is, and even on Saturday, Sunday, I'm on Twitter seeing what people are saying. It's
Yeah.
addictive. But
Yeah.
but
And it's
yeah,
not only
when
that. I mean,
when you're
I do
trained
trade.
that short term stuff, you got to be in the zone there.
Yeah. Yeah. No,
Yeah.
and it's not only for me. I do trade with other traders, and it's a
Yeah.
it's a signal service, and so I owe it to them as well, to not be distracted, and
Absolutely.
so it's very important.
Yeah.
As well. So
Yeah.
so, yeah.
Well, listen out. This was awesome. I really appreciate you coming on here. We went way longer, and I think we probably could keep going. I'm going to definitely ask you to come back,
Sure.
and because I think we got into strategy here, and we talked about everything. But I'd really like to have you come back and in different times and just talk about general state of the market stuffs, and maybe we can try to keep it under an hour.
Yeah.
But since
Absolutely.
this was the first one, I thought this was really great. So I really appreciate you coming on. If people want to learn more about you, I know you have, like you mentioned, you have a signal service with different things. What's the best way for people to find you?
Yeah. It's Facebook, Simple Option Strategies, or my website. It's also simpleoptionstrategies.com. And
Right.
from there,
Right?
yeah, simpleoptionstrategies.com. And so from there, there's different areas. I have a YouTube channel and other services as well.
Yeah.
But the goal here is, and I have a passion for this, is really to see other traders be successful, and be consistent at what they do. It's hard enough to do this on your own, but and you and I have a lot of commonalities, with what we do, and I think it's a great complement, our groups together as well, and we've always worked really well together, but yeah, that's
yeah, there's a lot of overlap.
Uh-huh.
Yeah, there's a lot of overlap, and I'm in the same boat, just trying to help people.
Yeah.
I have a service, you have a service. They're a little bit different. Maybe they're different fit, different style. Ultimately, you get into like what you understand.
Exactly.
If people understand what I do better, they're gonna maybe hang out with me a little more. If they understand what you have, they might hang out with you. And this is one of the reasons why I had you on, because it's not about getting members and all that. It's just helping people, and if they find value in your group, then I'm going to send them your way. And I know you do the same thing. So
Absolutely.
it's we're just I think for me it keeps me having a group as well keeps me on the ball. You really got to keep your game out. You can't get lazy. So it's been helpful to create a community, especially on Facebook and some of these other places. So so it's really cool. So I'm going to put all your links, your website, YouTube, and Facebook group, I'm going to put in the show notes on the website. And just as a reminder, anyone listening, if you want to get those show notes, you can go to stockmarketoptionstrading.com, and that is the website for the podcast. So Al, thanks so much. I will talk to you soon, and good luck with your trading.
Thanks, Eric. Appreciate being on, and really enjoyed the session here. So love it. Great. Thank you.
Thanks a lot.
Thanks for listening to the Stock Market Options Trading Podcast. To join our community of options traders, head on over to patreon.com/vertical spread options trading for details. But before you go, you should know that everything discussed on this podcast and in this episode is for informational purposes only and should not be considered financial advice of any kind.